The Bureau of Labor Statistics Consumer Price Index (CPI) rose 7.9% in February compared to last year, making the fastest annual jump since 1982. This took out January's previous 40-year high rate of 7.5% and matched consensus economist expectations, according to Bloomberg data. A surge in energy prices was one of the key contributors to the latest red-hot CPI print. Even before Russia invaded Ukraine and raised concerns about global energy disruptions, oil and gas prices were on the rise as demand for fuel oil and other energy products outstripped tight global supplies. In February, the energy index jumped 3.5% for the largest monthly rise since October. And over last year, the energy index was up 25.6%. A further impact from the Russia-Ukraine crisis and extended jump in energy prices that has ensued will likely show up in the CPI data in March, given the invasion first began in late February. Since then, gas prices at the pump have jumped to record levels, and crude oil prices have climbed to 14-year highs and at least briefly topped $130 per barrel. Russia's isolation from other global economies has also driven volatility across agricultural commodities, including wheat, for which Russia is the world's largest exporter, and added the specter for a further jump in food prices. In February, the food price index rose 1% month on month, also picking up slightly from January's 0.9% rise. This was driven in turn by prices for food at home, which rose 1.4% and brought the annual increase in this index up to 8.6%. One thing is clear, inflation is not transitory and here to stay. But how to protect your hard-earned money against inflation? Because you have to understand one thing, gas isn't getting any better, your money is just getting worse. Number one tip of pro investors: invest in TIPS. This stands for Treasury Inflation Protected Securities. In other words, a treasury bond that is indexed to an inflationary gauge to protect investors from the decline in the purchasing power of their money. The principal value of TIPS rises as inflation rises, while the interest payment varies with the adjusted principal value of the bonds. TIPS are a popular asset for both protecting portfolios from inflation as well as profiting from it, because they pay interest rate every 6 months based on a fixed rate determined at the bond's auction. If the principal amount is adjusted higher over the time due to rising prices, the interest rate will be multiplied by the increased principal amount. As a result, investors receive higher interest or coupon payments as inflation rises. Conversely, investors will receive lower interest payments if deflation occurs. You can easily find TIPS even here in Europe. For example, the iShares TIPS ETF is listed on major European stock exchanges from Amsterdam to Frankfurt and even in Tel Aviv, Israel. It gives you exposure to US dollar inflation-linked bonds, inflation-linked government bonds, single country government bonds exposure with inflation protection. Do you think TIPS are a good way to protect your money against inflation? Let me know in the comments below, and I thank you very much for watching.